Welcome back to Investing Talk Podcast. Today we're diving into a really interesting one, Navitas Semiconductor. It's a bit of a paradox, actually.
It really is. You've got this leader in tech pushing forward with gallium nitride, silicon carbide chips, super innovative stuff.
But then you look at the books and, well, they're burning through cash.
Exactly.
So the big question we're tackling today is simple. Does the promise outweigh the pain right now? Is this the moment to maybe buy Navitas stock? We're going to try and unpack its financial health, look at the technical signals from the charts, and talk about those more speculative catalysts that might be out there. And hey, before we jump right in, if you like this kind of analysis, please do subscribe, hit that like button. It really helps us out.
Ooh.
And if there's a specific company you want us to examine, just drop it in the comments below. We do read those. Okay, so let's get started. Navitas. They're not just any chip maker, right? They're quite specialized. Could you give us the quick rundown on what they actually do?
Sure. So think of Navitas as a pure play innovator. They're all in on these next-gen materials, GaN, which is gallium nitride, and 6CA silicon carbide. Basically, they build the engines for high-efficiency power.
High efficiency, so like faster charging, things like that.
Exactly. Super fast phone chargers, that's a big one. But also power supplies for data centers. And looking ahead, a potentially massive market in electric vehicles. Their technology lets devices switch power much, much faster and with less energy wasted compared to, traditional silicon chips.
Okay, so that sounds like a fantastic growth story on paper. Really promising tech.
It does.
But let's pivot to the financials, because as we hinted, the picture there looks quite different. What are the big flashing red flags we need to talk about first?
Yeah, we have to look straight at the Q1 2025 results. The tech story is compelling, but the market reality right now, it's pretty punishing. Net revenues for that quarter came in at only $14.0 million.
Only $14 million.
Yeah, and that's a huge drop, about 40% from the $23.2 million they did in Q1 of the previous year.
Wow, a 40% year-over-year decrease? That's steep. What's driving that?
It signals some really significant near-term demand issues. It seems like a pretty brutal industry inventory correction, especially hitting consumer electronics hard, where their GaN chargers first got traction.
So the tech might be great, but the market timing is just really hurting them right now.
Precisely. And it means they're nowhere near being profitable.
Okay, so revenue's down sharply. What about the bottom line?
Well, despite managing a pretty decent gross margin, it was around 37.8%.
Hold on, 37.8% gross margin. Is that actually kind of okay for a chip company scaling up in this environment? It suggests the product itself isn't the issue, right?
That's a really fair point.
Yeah.
Yes, it does suggest the underlying unit economics work. They can make the product profitably. The problem isn't pricing or manufacturing failure per se.
It's an expense problem then, and scaling.
Exactly, because even with that gross margin, they posted a net loss of $16.8 million for the quarter.
$16.8 million loss on $14 million revenue.
Yeah. The net margin is something like negative 120%. It's driven by really aggressive spending to try and grab future market share. They poured $12.7 million into R&D, another $11.7 million into SG&A.
So that spending leads directly to cash flow worries, I assume.
It does. The company reported using $13.0 million in net cash from operating activities just in Q1 2025.
13 million cash burn from operations on 14 million in sales. That's quite a ratio.
It is. The cash burn is significant relative to sales, and that means they have a reliance issue.
A reliance on equity financing, raising money from shareholders.
That's right, and that means dilution. That's the cost of keeping the lights on, basically. Just look at the share count. It went from 188.1 million to 191.8 million shares in just the first 3 months of 2025.
Oof, almost 4 million new shares in a quarter?
Yeah, mostly from stock awards and option exercises. This kind of ongoing dilution definitely weighs on the stock price.
Is there any good news on the balance sheet? Debt.
Well, the one positive financial point is that the company reports having no material long-term debt. That gives them some structural flexibility, which is good.
But they're paying for that flexibility with equity, essentially.
That's the trade-off, yes.
Okay, so the financial picture is, frankly, quite bleak. Contraction, cash burn, dilution. Yet the stock hasn't completely cratered. It's volatile, but it's holding certain levels. What are the charts telling us?
Yeah, the stock's definitely caught in a difficult spot, and volatility is the name of the game. Looking at, say, September 2025, it's been bouncing around between roughly $5 and $6.50 over the past month or so.
So it did rebound a bit from those summer lows.
It did. It got down near $4.50 during the summer, But even at $6.50, it's still way below the highs we saw early in 2024 when it was up over $10.
And technically, what are the key levels traders are watching?
Well, that $4.50 to $5 zone seems to be pretty critical support. Those are multi-quarter lows.
Yeah.
On the upside, resistance looks like it's sitting around $6.50 to $7. That's a level where it recently got rejected.
What about the trend, moving averages?
Not great news there for the bulls. The 50-day moving average is currently running below the 200-day average.
The classic bearish signal.
Right. It suggests that a medium-term downtrend is still in place. And it kind of confirms that any recent spikes we've seen were probably just noise, not a real structural shift yet. Volatility remains super high, which, is typical for these smaller, unprofitable semiconductor stocks.
We did see some wild moves earlier this summer, seemed almost disconnected from the fundamentals. Can you link that trading action to specific news events?
Absolutely. The momentum swings have been pretty dramatic. Like back in July, the stock suddenly surged, shot up 50% in just about 2 weeks.
50%? What drove that?
It looked like purely short-term technical buy signals kicking in. Just momentum traders jumping on board.
But it didn't last.
No, that euphoria faded fast. Then in August, we got news of a CEO transition.
Leadership change, uncertainty.
Exactly. That injected a dose of doubt among investors, especially institutional players. They get nervous about leadership stability, particularly during a tough period like this, cause quite a bit of volatility.
Interesting. And what about insiders? The execs, the directors, are they buying the dip, selling? What's the sentiment there?
Well, analyst consensus is pretty much stuck at hold or neutral. Lots of uncertainty reflected there. And insider activity, we've seen some minor option exercises, people exercising awards that vested. But the crucial thing is there have been basically no open market purchases or any large sales by executives or directors during Q2 or Q3 2025.
So they're not running for the exits, but they're not putting their own cash in either. Kind of neutral.
Pretty much neutral, yeah. And that, combined with the retail investor sentiment, which seems kind of neutral to negative because of the profitability worries, it suggests the leadership isn't making really high conviction bets at the current price levels.
Okay, let's shift gears then. The present situation looks tough, dominated by pain points. So the only real reason to consider buying this stock now must be based on the future, right?
Absolutely.
What are the potential catalysts, the things on the horizon, that could maybe justify taking a risk here, particularly for someone with a high tolerance for that risk?
Yeah, the whole bullish case really hinges on things that might happen. In the near term, everyone's laser focused on the Q3 2025 earnings release that's expected sometime around November.
High stakes for that report.
Definitely. Volatility around earnings is pretty much guaranteed, especially since some technical models are actually forecasting, believe it or not, potential gains of up to 267% if the results somehow surprise positively. Like if they show revenue starting to accelerate again.
Wow, 267% upside potential based on technicals. That highlights the volatility. Anything else short term?
Traders are also keeping an eye on the ETF rebalancing that happens in Q4, usually around October. Sometimes that can force institutional funds to buy or sell, injecting capital quickly. It's more of a technical factor, though.
Okay, those are more like short-term hope plays tied to results and flows. What about the bigger, more transformative, maybe more speculative bets?
Right. That's where you get into the really high-risk, high-reward stuff. The M&A chatter, for example. There's this persistent market talk, sort of rumors, that Navitas could be a takeover target.
By whom? Bigger chip companies.
Yeah, larger semiconductor firms looking to quickly acquire GaN expertise, or maybe even private equity, seeing it as an undervalued platform technology.
So buy the company, fix the finances, unlock the tech value.
That's the theory. Then you also have the product rumors, whispers about a disruptive next-generation gallium nitride chip launch, or maybe landing a major strategic partnership, say, with big electronics manufacturers in Asia. That could instantly guarantee high-volume orders they desperately need.
Okay, those sound potentially game-changing, but they also sound uncertain.
Highly uncertain. Pure speculation at this point, mostly.
Which brings up the crucial question, what are the biggest risks? The things that could completely derail these potential catalysts, even if the technology itself continues to impress.
Yeah, the risks are significant, mostly centered around execution and scale, I'd say. Risk number one is just the obvious. Persistent unprofitability and that cash burn.
Can they turn it around before the money runs out or dilution becomes unbearable?
That's the key question. The ongoing losses and dilution are a genuine existential risk if that revenue acceleration doesn't materialize, and soon. They really need to show a clear, believable path to sustain growth before they burn through their liquidity.
Okay, execution risk. What else?
Risk number two is competitive pressure. And they're disadvantaged in terms of scale. Navitas is kind of like a super fast, cutting-edge Formula One car, but it's racing against these huge fleets of semi-trucks.
The big established players?
Exactly. Industrial giants like Infineon, On Semiconductor, Texas Instruments, they have vastly greater scale, more diversification, deeper pockets. And they could potentially just underprice Navitas in key markets like automotive or industrial, making it really hard for Navitas to gain share even with better tech.
So Navitas has to maintain a significant technological lead just to compete.
They absolutely do. That edge is their main weapon against the scale gap.
And we can't ignore the broader economy, right? They're not operating in a vacuum.
Not at all. Risk number three is just basic semiconductor cyclicality. The whole industry goes through inventory cycles, and they're exposed to global macro headwinds just like everyone else. That 40% revenue drop in Q1, maybe it wasn't just a Navitas problem, but more a sign of the broader struggle in the electronics market they serve. They're fighting the tide.
Okay. We've covered a lot of ground. The really challenging financials, that revenue contraction, the cash burn, the dilution, the tough competitive landscape, the volatile stock chart, but also the potential game-changing catalysts like M&A or a big tech breakthrough. So let's bring it all together. For our listener who's trying to make an informed decision based on everything we've discussed, is Navitas Semiconductor a good buy right now?
Looking at the totality of the information, the overall sentiment has to be overwhelmingly cautious. It leads to a rating, really, of about 4 out of 10.
4 out of 10, that's
Yeah.
pretty low. It really underscores that paradox we started with.
It does. The technology story, the innovation in GaN, and cited the large potential markets. That's genuinely positive. But right now, it's just completely overshadowed by that steep revenue drop, the ongoing deep losses, and a constant share dilution.
So what's the bottom line for an investor considering this?
Well, valuation is just incredibly difficult to justify without a much clearer, more credible path to sustained profitability. So the conclusion really is this stock doesn't look suitable for short-term trading. It's too volatile, and there are no clear signs of a reversal yet.
And for long-term investors.
It's also not really suitable for long-term investment unless you see concrete evidence of accelerating sustained revenue and gross profit growth starting to happen.
Yeah.
Or, unless that acquisition interest becomes much more credible than just rumors.
So wait for proof of a turnaround or a real buyout offer.
Essentially, yes. The risk-reward just doesn't seem favorable at this exact moment based on the fundamental.
Thank you. That's a really crucial analysis of Navitas. Appreciate you walking us through all that.
My pleasure. And maybe here's a final thought for you, the listener, to chew on. Given all that speculation swirling around M&A or these maybe next-gen chip launches, how much value should you realistically assign to those high-risk, high-reward possibilities, especially when the actual immediate financial performance is contracting so sharply? Are you betting on the core technology eventually winning out, or are you really just betting on a lifeline, like a takeover, something to really mull over as we wait for those Q3 earnings results around November?
That is an excellent question. Really gets to the heart of the dilemma with a stock like this. We'll definitely be watching those Q3 results closely. Thanks again, and thank you for tuning in. We'll see you next time for another critical analysis right here on Investing Talk Podcast.